Hi there. In this video, we explain the Spring Statement 2026 dividend tax changes and what they could mean for UK company directors.
A business owner runs the exact same profit extraction strategy as last year, expecting the exact same take-home pay. But when April 2026 hits, a significant chunk of that money is quietly swept away. Welcome to Pro Tax Accountant. Today, we are breaking down the 2026 UK Spring Statement, focusing specifically on the hidden dividend tax traps waiting for company directors. There is a dangerous assumption circulating right now. Because the Chancellor didn't announce a massive, headline-grabbing overhaul of the tax system, many directors think their traditional low-salary, high-dividend autopilot strategy is entirely safe. That assumption ignores fiscal drag. It happens when the government freezes tax-free allowances, while inflation and wages naturally rise over time. Your income grows on paper, pushing you into higher tax brackets, even though your actual purchasing power hasn't improved at all. Leaving your 2026 strategy on autopilot guarantees a massive, invisible leak in your corporate profits before the money ever reaches your personal bank account. Let's look at this split-screen bar chart detailing the exact numbers taking effect on April 6, 2026. The dividend tax rate is jumping up by 2 full percentage points. The basic rate climbs from 8.75% to 10.75%, and the higher rate moves to 35.75%. Under the 2026 rules, that exact setup triggers an automatic penalty. Because of the rate hike, that contractor pays exactly £744 in extra tax. Scale that up to an SME director maxing out higher rate bands, and the damage compounds. The extra tax hits £2,492. You also have to factor in the employment allowance, a provision giving eligible businesses up to £10,500 to offset employer national insurance. If you qualify for it, taking that $12,570 salary still makes sense. If you don't, which is true for many single director companies, you need to drop your salary down to the lower earnings limit of £6,708. This is just to dodge the 15% employer national insurance charge. The math of 2026 systematically destroys the one-size-fits-all approach to extracting your profits. So if dividends are getting squeezed, what about leaving the money in the company and borrowing it through a director's loan? That route just became significantly more punitive. The Section 455 charge, the tax a company pays when a director overdraws their loan account, has escalated. It is now 35.75%, explicitly hiked to mirror the new higher dividend rate. On top of that, the grace period for messy bookkeeping is ending. Under the Making Tax Digital mandate, self-employed directors and landlords earning over £50,000 must begin filing quarterly digital updates to HMRC starting in April 2026. You can no longer rely on a single annual catch-up with your accountant. Maintaining proper, up-to-date digital records is now a strict requirement for surviving this new quarterly reporting regime. Every alternate route for managing corporate cash flow, whether through loans or delayed reporting, has been systematically blocked or heavily taxed. Hearing all of this, you might assume the dividend extraction strategy is entirely dead. It isn't. Looking at this side-by-side scale, you can see why dividends still win. Taking a high salary carries a brutal 23% combined national insurance burden, 15% from the employer and 8% from the employee. Dividends completely bypass national insurance, keeping the overall math firmly in your favor, even with the 2% hike. What is obsolete is the passive set-and-forget payroll. Operating a UK business today requires a dynamic, highly customized tax extraction strategy that reacts to your specific revenue and allowance eligibility. Keep in mind, this overview is strictly educational. It does not constitute financial advice, and you should always consult a professional before altering your corporate tax structure. If you are a startup founder, contractor, or SME owner, you need to stop leaking profits. Reach out to Pro Tax Accountant, and we will build a tailored extraction strategy for your exact situation. Give us a call at 07985 689 912. Email us at info@protaxaccountant.co.uk. or visit our website at protaxaccountant.co.uk. If you found this breakdown helpful, please like the video, subscribe to our channel, and hit the notification bell so you never miss an update on UK tax legislation. In an era defined by stealth taxes and frozen thresholds,
proactive and aggressive tax planning is the only reliable shield for your hard-earned wealth.